Hello, traders. Let's have a serious discussion about how smart money manipulates the market to trick us into doing what they want. Few experiences in trading are more disheartening than having your stop loss hit, only to watch the market immediately reverse and surge in the direction you originally predicted. This common occurrence often leads traders to question whether they are merely suffering from terrible misfortune, or if there are deeper, more systemic forces at work within the financial markets they are attempting to navigate. In today's video, our focus is entirely on the concept of smart money manipulation. I intend to expose exactly how the largest market participants lure you into clicking buy or sell at precisely the wrong moments to benefit themselves. Therefore, I would appreciate it if you could like this video, subscribe to our channel, and remain with us for the entire breakdown. Institutional investors, or smart money, possess a significantly clearer view of the supply and demand landscape than the average individual ever could. It often comes as a shock to novice traders when they discover just how frequently markets can be maneuvered. While there are various professional entities involved in finance, such as brokerages, massive banks, and trading consortiums, the primary price action is ultimately funneled through a select group of dominant players known as market makers, often referred to as professional money. These are the entities responsible for essentially constructing the market. They have the capability to view incoming buy and sell orders in real time. Furthermore, they often execute massive block orders using specialized tactics designed to prevent the price from spiking against their own interests or those of their clients. A major advantage these traders hold is the ability to visualize where stop-loss orders are clustered on their terminals. They are also privy to inside information. Even though insider trading is technically against the law, we must be realistic. Privileged data is utilized constantly in various manners to generate substantial profits. Simply put, smart money gauges the equilibrium of supply and demand with far greater accuracy than any retail trader. The footprints of smart money activity are revealed through volume and price spreads. Professional strategies vary widely, from rapid scalping to the slow, methodical accumulation and distribution of assets. However, the true outcome of their involvement is always imprinted on the chart via volume and the spread of the price bars. Volume indicates the intensity of trading activity, while the price spread reveals how satisfied professional money is with that specific level of activity. This is why analyzing the spread is so critical. That said, it is crucial to understand that smart money employs various tactics to optimize their entries and exits, such as forcing stocks to gap up or down, executing shakeouts, conducting tests, and creating upthrusts. These are specific strategies designed to generate revenue for them, often directly resulting in a loss for you. Smart money requires that their true intentions remain as concealed as possible. Market makers are adept at identifying windows of opportunity far better than the average participant. They view news events, whether positive or negative, as chances to act. As a retail trader, you are generally kept in the dark regarding these maneuvers. The absolute last thing institutional players want is for the general public to realize that a specific asset is being quietly accumulated or distributed. Secrecy is essential to their operations. It is not uncommon for smart money to resort to extreme measures, such as generating false rumors, a practice much more prevalent than you might suspect, or overtly selling a stock in the public eye while secretly buying back even more shares through different channels. For instance, if institutional traders anticipate a price increase, their goal is to trigger all the stop losses to clear the board before driving the price upward. If they know the value is going up, naturally, they want to acquire the asset at the lowest possible cost. Conversely, consider a scenario where you see stellar earnings reports and strong fundamentals that lead the public to expect a price surge, yet you watch the stock price plummet instead. This is another classic smart money tactic. Top-tier professional traders know how to decipher the subtle relationship between volume and price movement. Practically speaking, professional money is comprised of a massive volume of trades that, if substantial enough, will fundamentally alter the market's trend. Their absence from the market is just as significant as their presence. If these major players are not interested in driving a rally, you will observe very low volume, a condition known as no demand. This is a reliable indicator that any upward price movement will be short-lived. Keep in mind that it is the actions of professional traders that drive significant volume shifts, not the small-scale activities of retail traders like you or me. Smart money frequently utilizes news cycles to improve their positions and exploit common human vulnerabilities. These institutions have a deep understanding of trader psychology. They are fully aware that the vast majority of traders are driven by two primary anxieties: the fear of missing out, and the fear of losing capital. Often, they will leverage breaking news to optimize their entries and exits by preying on these known psychological triggers. If a news story is negative and it suits their current objectives, market makers can rapidly mark down prices. Weak-handed buyers are easily shaken out of their positions at bargain prices. This technique is particularly potent if the news seems catastrophic. Stop-loss orders are tripped, allowing the professionals to scoop up stock at discounted rates. Simultaneously, traders who shorted the market due to the bad news can get trapped by a swift reversal. As these short sellers rush to cover their positions, they are forced to buy, which fuels the rally for the professional money that was holding long positions all along. The primary element smart money aims to obscure is not the price itself, but the volume. While price action instills emotions like fear or hope, volume provides the cold, hard facts. Although markets may differ in minor details, every free market globally operates on these same principles. The more liquid and heavily traded a market is, the harder it is to manipulate. Market makers cannot simply dictate prices in a vacuum. This is mostly feasible in thinly traded environments. While manipulation is common and should be expected, smart money still requires specific windows of opportunity, such as a temporary lack of depth in the order book or the cover provided by major news events. Smart money is acutely aware of how you are likely to behave as an investor. Whether we wish to acknowledge it or not, humans are biologically wired to follow the herd, and the media is instrumental in shaping the opinions traders form about assets like stocks, futures, Forex, or cryptocurrencies. When media-driven narratives are incorrect and the uninformed herd follows them, the financial cost is severe. This is because smart money anticipates your reactions. They know exactly how to guide you. They understand that greed and fear are the most potent human emotions, and that these feelings are detrimental when making logical trading decisions. You might be asking yourself, are these smart money players evil villains trying to steal your funds? Certainly not. They are simply intelligent institutions that have mastered human nature and market mechanics. They treat trading as a competitive game and have developed the necessary skills and knowledge to emerge victorious. They are merely capitalizing on opportunities that present themselves. They possess financial dominance and a superior grasp of how markets function. This gives them a distinct edge over retail traders, which they utilize to generate profit. Volume spread analysis is the retail trader's primary defense against smart money. You might be wondering, how does this help me make money? Why not just teach a specific strategy? The solution lies in volume spread analysis, VSA. However, before you can effectively apply VSA, it is absolutely critical to internalize this background information. To win the game, you must first acknowledge its reality and understand the rules. When I began my trading journey, I initially refused to believe this was how the world worked. But as I scrutinized the markets more thoroughly, undeniable patterns emerged. You likely know these patterns well. You identify a solid support zone, perhaps reinforced by a moving average or a psychological round number. You buy in expecting a rally, but the price dips just below support, triggers your stop loss, and then rockets upward, often hitting your original profit target. It occurs relentlessly. Your first instinct is to blame your broker. While it is true that using a broker from an unregulated jurisdiction can lead to abnormal spikes and widened spreads due to shady practices, it is usually not your broker hunting your stops. It is the smart money participating in the market because they require your stop orders to generate revenue. Stop-loss orders provide necessary liquidity. Large institutional players cannot enter a massive position instantly. They must construct it gradually by hunting for liquidity. And hitting clusters of stop-loss orders is the most efficient method to source that liquidity. Smart money actively entices retail traders to commit to the wrong side of the market. Consider two prevalent trading myths. The more obvious a support level is, the stronger the signal, or place your buy entry at support and your stop loss immediately beneath it. These are standard instructions found in almost every trading textbook. I have likely even repeated them in my earlier content. However, consider the logic for a moment. If the entire crowd wants to buy at a specific price, who will sell to them? Every buyer requires a seller. If smart money intends to buy at a support level but knows the masses are trying to do the same, they must engineer a way to get traders to take the opposite side of the transaction. Their goal is to seduce traders into positioning themselves incorrectly. It is a straightforward tactic, and you have likely witnessed it countless times without realizing what was happening. Let's revisit the example of buying at a support level following a decline. The price almost never halts exactly at the line. That perfection is reserved for textbooks. In the real world, price usually pierces through the level. It appears as though support has failed and a breakdown is imminent. This is the perfect scenario for smart money. First, impatient traders who bought the touch of support see price hitting their stops, which become sell orders. Second, breakout traders begin selling short. These retail groups are effectively selling their shares to the smart money, who are gladly buying at a discount below support. The price then rallies, triggering the stops of the short sellers, which accelerates the upward move. The only ones left with profit are the smart money. The most agitating aspect for us as retail traders is that our original analysis to buy at support was accurate. Yet, practically speaking, we still lost money. Smart money is expert at triggering your greed and fear. Imagine the price is at $58, dropping toward a major support zone at $50 where you and the vast majority of traders plan to buy. Frequently, you will see a reaction before it gets there. If the price stalls at $52 and ticks up slightly, impatient retail traders become anxious, fearing the market has found a bottom and will leave without them. We retail traders are naturally greedy and despise the feeling of missing a trade. Smart money is fully aware of this and exploits it. They lure amateurs into pulling the trigger prematurely, entering long positions before the price reaches the true support. You can guess the result. Smart money drives the price down further, causing panic among the early buyers, and then collects their shares when they sell in fear of a breakdown. So, you might question, is market manipulation inherently positive or negative? My perspective is that if you can master chart reading through volume spread analysis, you will unveil the intentions of the smart money, allowing you to trade in alignment with reality. After all, wouldn't you do the same? Buy at the absolute bottom knowing you could sell higher later? That is the essence of the trading game. Buy low, sell high. But to achieve this, you must first learn how to stop being the victim of these manipulations. You need to understand the mindset and tactics of the major players. You must align your strategy with theirs and follow their lead. If this resonates with you, please ensure you watch our playlist on smart money. If you gained value and learned something new today, please leave a like. This helps us gauge if you want more content like this.